Hello, I'm going to be taking you through HorizonLens, the financial planning application, and in this video we'll be looking at a deeper dive into the table view in HorizonLens. So let's say we are currently got this plan selected and we are looking at this table view. So we want to try and understand or get a better understanding of the values in this table and how they're made up. And we can do that by using the underlines here. We can click on these underlines to find out more information. So let's have a look at where we have an income. So the current income here, if I hover over it, we have the gross salary of 56,000, which is set in the income in the current situation. And then we have any reductions. So that's reductions that's taken straight out of the gross salary. So a situation could be, for example, that we have a salary sacrifice pension. And if we have it there, then it will be specified in the reductions. Then the tax is calculated on the gross amount minus any reductions in the case of a salary sacrifice. Otherwise, it's just on the gross. We have a tax here of 12,963. If we can click on that, we get further information how that tax is actually calculated. So we have the gross income here of 56,000, and then we have our income tax 9832, and our payroll deductions and net income after tax. We then have the breakdown in this section here, showing the actual gross and then the tax and any national insurance. We can click on that information further and we can see exactly how that's made up. We have the gross income, the personal allowance of 12,570, and then that gross minus that allowance, how much has been taxes coming from the basic rate, or based on 37,700, and then the tax on a higher rate of 40%, giving the income tax total of 9832. We can do the same thing for the payroll, for the national insurance as well, the primary threshold at the upper earnings limit, etc. So a very useful view for being able to dive into the actual detail of how the tax is calculated. We can also click on the trace and you can see the bands made up inside these national insurance, etc. So that's the tax calculation, and then we can look at that. Then gives us the net amount, so the gross minus the tax gives us the net value here, which is specified here. Then we have taken off any expenses and spending. So what is that here? That's 12,000 in this particular plan, which is shown on the 12,000 here. We have the spending. We can click on that and we can see how that 12,000 is made up, which is basically the living expenses on this particular plan. So let's go back to here again. That gives us the post expenses, which is the net minus the expenses and spending, giving us 31,037. Underneath that, we have any manual contributions. So this is contributions to any investments and pensions that's deducted straight away from the income as it goes out, which you can specify in the current balances, giving us the remainder, which is anything left over after the expenses and the manual contributions, is 12,837, so effectively the surplus. We then have any deductions or allocations to any savings goals. The savings goals are just kind of virtual pots, I suppose, like emergency funds or holidays and stuff like that, which are kind of, you want to make sure you allocate money to certain goals. Then you can do that here, and then that is the amount left over of 11,837. So you can of course go through the various years and seeing the information change by clicking on it. Then we move across to the drawdown. You're not going to get any drawdown in the accumulation years, which is prior to retirement. Retirement's marked on the year here, and you can see the milestone. That's where it says drawdown. We can click on the drawdown here. That's going to give you a breakdown of that. So we have retirement spending of 42,000 in this particular plan. There's no income coming in, hence why it's zero. So we have to fund 42,000. How are we going to do that? Well, we've currently got in this particular year of retirement 58. There's 67,000 sitting that's been unallocated in or not been invested, for example, just sitting in a cash account of 67,961. This is our available net assets. So that is everything minus any real estate. So this is all liquid assets or cash assets if you want, including what we have inside any sort of floating cash in the income surplus gives us this 1.2 million. We're then going to spend the 42,000 retirement spending from that amount, and that's coming directly from the income surplus. That's his job there, leaving it as a balance of 25,961. So this means that we're not actually tapping into or reducing the money from any of the investments. So you can have then a kind of breakdown here, an explanation of that. So we're planning to spend 42,000. We have no zero income, so we need to fund 42,000, and it's just explaining really that's coming from the income surplus. We can then click on account breakdown and seeing how that's made. So we have 67,000 sitting in income surplus. We are spending 42,000. That's how much is left at the end of the year. If we click through next year, we can see that 25,000, which was the end balance of the 2032, and then click again, and it's then spent the money or from the income surplus, which has then drained it to zero, and that means it's now having to spend the cash from one of the other pots, which in this case is taking it from the pension in this particular drawdown method. So let's just, or if we click on the tax, we can also see the breakdown of the tax in that year as well. So we can see the 12,000. So it's taken the tax from the pension because that is the tax efficient way, just up to the personal allowance, but not any further. Let's just close that down, and then we go to the contribution here. We can hover over that. We can see we have the various contributions. This is a prior retirement. How these are made up. We have the contributions going in from the income surplus into this particular account here, contribution II, interactive investor. This is coming in as a net amount. We are then applying tax relief of £900, giving us the gross of 4,500 going into that pension. And that's going through the other pots as well. So we have, for example, another investment account here, 2,700. There's a tax relief on that, giving a gross contribution of 3,375, and so on and so forth. There is a slight difference between this one here because this is a actual work pension, so we actually have a deduction or a contribution from the employer coming into that one there. Let's just close that down there, and we can then look at the growth as an example. Let's say take the growth here, see how this is made up. This is our start balance at the beginning of the plan, 859,275, and this is the amount added to our actual portfolio. And this underneath is how it's made up, these three lines. We have a manual contribution of 21,125. We also have the actual contribution directly from payroll of 1,680 and also 280 from an employer pension contribution, which is, if you add those three up, it comes to 25,605. We haven't withdrawn anything from the accounts at that point because we are actually in the accumulation stage. This is the amounts from growth, so that's basically the start balance, 859, plus the 25,000, giving us the base of before we apply the growth. Then we have our growth applied to the accounts of 18,000, based on these rates here. This is the nominal rate. This is the rate after inflation's taken into consideration, the real inflation, the real growth rate. That gives us the end balance for 9,016. And we also then have any balances of the income surplus that's not actually being invested into any accounts. It's been held kind of in limbo for expenses. And then the amounts going into the savings goals. this is basically an explanation of that, what I've just explained already underneath as a reminder. And then we have kind of a diagnostic section to allow those interested in seeing exactly what goes into each of the accounts. For example, we've got the various account types here: cash, ISA, GIA, and pension. And that gives you the contribution going into each of the pension group, the pre-inflation growth rate, the inflation that's been applied, and the amount after inflation of 2.91%, and the growth and the end balance for the actual account types. And then you can go into the various accounts themselves, which are basically a further detail underneath the account types. So we have, for example, like inside GIA, we have these accounts here, which is basically the ones inside the GIA account type here. So you can sort of dive into the various contributions on that level. And then we go into the end amount here, which is allowing us to see what the balances are at the various points for each of the account types. So this is the net assets. So we have cash, ISA, GIA, pension. We then have the added amounts. So if I hover over this, you can see the amounts being added to each of the ISAs, for example. And then the returns applied, now how that's calculated. We also have the change just here, and then the end amount. So all in all, you can see that the table is a very comprehensive and effectively a low-level tool that allowing you to dive into the underlying projections inside HorizonLens, how all the end amounts are calculated for your projection going forward.